Good day and welcome to the first recap for 2022. First of all, let me take this opportunity to wish all our viewers all the very best for the new year ahead. Now let's take a look back at the final quarter of last year, particularly as it relates to markets and our momentum focus and target fund of fund ranges. As you may recall, September saw the majority of major indices struggle as investor sentiment softened in the wake of the Fed taking a more hawkish stance and announcing the potential reduction in their bond buying program by as early as November. In our view, this should not have been news to the market, so the reaction was perhaps a bit overdone. Now, in contrast to a rather pedestrian third quarter, the final quarter of 2021 proved to be a much more successful one for risky assets. Global equities generally benefited from the risk-on trade, which seemed to ignore or suppress the impact of what looks to be a much milder version of the coronavirus in the Omicron variant. In spite of a very volatile 2021, many markets however reached new highs towards the latter part of last year. Especially developed market equities put up a very strong showing. The negative emerging market sentiment, spearheaded by the Chinese government's regulatory crackdown, as well as their property woes, spilled over into the fourth quarter. A key driver of future outcomes and volatility remains the projected path of tapering, or the reduction in asset purchases by the US Federal Reserve, as well as the inflationary pressure which could pave the way for interest rate hikes sometime in 2022. Economic growth, however, is seemingly still intact, and corporate profits are continuing to show some resilience. Over the quarter, domestic equities and properties gained more than 8%. This gain pushed the asset class to a 12-month record return of a little more than 27%, as recorded by the FTSE JSE Capswix All-Share Index. These short to medium-term gains has only marginally lifted the longer-term performance of the asset class, with local equities outperforming inflation on an annualized basis by 2.8% over a 5-year investment term. Now, this is still a long way off from our long-term expectations for the asset class. Over the quarter, resources and industrials carried the load for the asset class, recording gains of nearly 22% and 16% respectively, while financials only mustered 2.5%. However, financials ended the year on nearly 30% compared to 32.3% for resources and nearly 27% for industrials. Ongoing inflationary concerns saw if the ILBs continue a strong run with a healthy return of 5.3%, while nominal bonds offered a respectable 2.9%, followed by cash with just over 1% for the 3-month period. As I alluded to earlier, the MSCI Emerging Market Index underperformed its developed market counterparts, while the rand weakened by 6.2% during the quarter. This brought the MSCI All Country World Index return to a pleasing 12.6% in local currency terms. The currency weakness also benefited global bonds, as well as global property, which had a strong showing with nearly 17% in local currency terms, as the globe continues to learn to live with the pandemic and a possible transition to an endemic looking more and more likely. Now, against this backdrop, the momentum focus and target fund of fund ranges continued their strong run and ended the year on a positive note with returns of between 6 and 8.5% for the quarter. This brings the 12-month return for the funds to between 16.3 and 23.3%, depending on the risk profile of the fund. Within our funds, we remain tactically positioned for the ongoing recovery, although we do expect growth to slow compared to 2021. As is always the case, we remain well diversified across asset classes, strategies, and managers, and positioned for the prevailing market conditions. Thank you for listening.